My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll be one of my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Okay, it's finally happening on an ugly day where the Dow lost 71 points, the S&P plunged 0.53%, and the Nasdaq plummeted 1.13%. Wowza! They jeweled that Nasdaq. The market's finally reacting to the glut of new IPOs that are weighing on the averages like a steamer trunk on the investment public's back. I take no joy in this, but I told you so. All year I've been predicting that the IPO cycle would end with a whimper, and now it's here. Busted deals like Peloton on the heels of Smile Direct and Lyft and Uber. They're booing, are becoming the norm. I think there's a big reason why this market keeps getting hammered, especially the turbocharged growth stocks. Oh, boy, you see them today? It's gotten to the point where I hope the president actually follows through with a threat to block more Chinese IPOs, if only because so many of them have been unmitigated disasters for their investors. I know chatter about some limitations on Chinese investments by the president caused the market to get hit today because anything that's not flat out suggesting compromise indicates that we're much further away from a trade deal than the bulls had hoped. As someone who wants the Chinese to play fair, I think a ban on Chinese IPOs would be a blessing. But after stiffing around, that's not what's in the card from what I can tell. It turns out the talk is really about limiting American investment in Chinese companies. And it's not as sweeping or as negative as the market seems to believe. Look, the White House isn't happy with American pension plans, especially federal pension plans, having to add lots more Chinese exposure, which is what's recommended right now by an outfit called MSCI, which is the keeper of the international index weightings. That's what all the big funds follow. The administration doesn't want Chinese listings that lack the same kind of transparency as American companies, and it would prefer our investors not to buy the shares of companies with opaque financials that Mao would no doubt like. You know, to me, I think it would be simpler to ban new Chinese IPOs here altogether. But that's not in the cards right now. That's not in the cards, despite the fact that you may have heard that this afternoon. It's just not true. So, candidly, if you sold stocks on those rumors, in retrospect, it was ill-advised. I only took about 4 hours working on that one today. Unfortunately, we won't be catching a break from something else, though. A continued deluge of new American-style deals next week. When I look at the IPO calendar ahead of us, you know what? It makes me sick. I mean, we've got 5 money-losing biotechs on deck now to complement all the other money-losing merchandise that's been pumped out of us lately. Don't you feel like that when you're in this IPO moment, what you really are, you're like Danny Dufresne going through that pipe, right? I mean, wow. You know exactly what I'm talking about. I'm talking about Shawshank. Yeah, these deals are designed to rip the money from your portfolio. You know what? No, I have a better movie imagery. What this is like is Indiana Jones and the Temple of Doom when they reach in and pull your heart out. Kind of. All right, the closed rack that is Peloton was the straw that broke the IPO camel's back this week. We all knew the chute had effectively been closed for money-losing companies. The underwriters didn't seem to mind. Although that may be changing. The only encouraging sign of this hideous moment was when an outfit called Endeavor, where my agent works, pulled its IPO. They got horse sense. How and why did they do that? Simple. Because unlike most of the junk that is being pumped out now, Endeavor actually makes a lot of money, so they didn't need any of this stuff. They were hoping to use their stock as currency to buy other companies. But when they saw the state of the IPO market, they said, hey, to hell with it. Endeavor didn't want to be lumped in with the Pelotons of the world. The company brought in $500 million of earnings before interest, taxes, depreciation, and amortization last year. So they have no urgent need to raise capital despite of what you may have read or whatever. I mean, I'm glad they chose not to swim in the IPO Gowanus Canal, which, for the record, was a very odd blue color the other day. Interesting. Blue. But, kind of blue like, I don't like a crayon, like cerulean. Now, from this point on, you can't afford to own any of the newly minted money-losing IPOs because what you'll do is you'll lose money. You'll be living here.
The house of pain.
And I know they may have some potential for incredible growth, but the market doesn't want that anymore. You see what it did to all the high-growth stocks today? See, we're in the wrong stage for the business cycle. In fact, the only deals I want now are deals where raising money is a secondary concern. In most cases, these companies are desperate to do some fundraising. I want you to stay away from them. Can you imagine if that WeWork had come public and then we discovered what we found out? Can you imagine? What a travesty. Government, would you at least try to protect us? All right, with that in mind, what can we expect next week? On Monday, we hear from Thor Industries, and that's an RV maker. There was a time a couple of years ago when millennials loved camping, and Thor looked like it was going to be a big winner. But then labor costs went up, raw costs went up, and the customer interest went down. The next thing you know, it's a serial disappointer. Early last year, this stock stood at 161. Now it's at 49. I don't want to be too tough on management here. This is not unique to Thor. The whole camping cohort's been crushed. If there's ever going to be an upside surprise here, it's going to be in this quarter because interest rates have finally gone down. For now, though, I think it's too risky. Thor needs to deliver at least one quarter, please, of good numbers before you have my permission to circle back. Hey, listen, if it goes to 60, but it's really going to get it together, you got plenty of time. Tuesday, one of my absolute favorites reports, McCormick. And you know what we know McCormick as, okay? It's the spice and hot sauce company. And this is the best, by the way, this particular version. Now, its stock was hammered today in very little volume. If it keeps falling on Monday, you know what? You're going to get a good opportunity to buy this thing. And McCormick's one of the few companies in the supermarket that's got real growth. Next up, the market will this market ever really embrace high-flying growth stocks again? Sometimes it feels like they'll never bounce back. But the pendulum has swung too far. Right now, we're in the pit, and we need some signposts to figure out when things are swung too far. Which brings me to Stitch Fix. Stitch Fix is the online subscription service that regularly sends the shipments of apparels, accessories, and shoes. Think of it as a style as a service business. SaaS! Stitch Fix reports after the close Tuesday, and while it's profitable, the price earnings multiple is absurd. Of course, expensive valuations never seem to matter to the stock until June. Since then, it's been jeweled. It's going from 32 to 18, despite there being no real negative news. That's what happens, though, when you go out of style on the Wall Street Fashion Show. Watch how this one behaves after the quarter. It could be crucial to be able to give you a sign that this craziness toward high growth is over. How about Wednesday morning? Well, then we get results from Lennar, the big home builder. Given that housing has become the brightest spot in the economy, it's no wonder that Lennar is up 40% for the year. Housing's responding to lower interest rates. Shocker. So if this stock gets hit on the quarter, call me a buyer. After the close, we're going to find out if Bed Bath & Beyond can pull out of its extended multi-year tailspin. Now, the activist investors are now in control. Good lucky. But this stock's been a nightmare for ages for anyone who's touched it, except if you're Target, because they've been a fabulous share donor to any Target that's nearby. That said, Bed Bath finally looks like it's kind of sold out. Notice the bottoming pattern this week? Let's hear what they have to say before you try to pick at this one, though. Maybe what I'll do is I'll use that for off the charts next week. Let me noodle. Thursday, we get results from three terrific companies with stocks that have been performing well ever since the rotation into the safety plays got rolling over the summer. I'm talking about PepsiCo, Constellation Brands, that's in the morning, and Costco after the close. I think PepsiCo is exactly what works in this dicey environment. I'm looking for 5% organic growth and recognition that I'm sorry that I've been drinking so much Diet Mountain Dew lately. Constellation might help us understand its cannabis strategy. They took a big position in now only canopy growth. Not to mention, please have something to say about Spike Seltzer, which is the hottest part of the alcohol market. And I got to tell you, I downed a couple of them the other day thinking that they were just club soda. Wow, I was flying. All right, how about Costco? Now, this stock's been it's been up for ages, which is why it is the C in WATCH, which is my acronym for Walmart, Amazon, Target, Costco, and Home Depot, which I'm sure some joker in childhood is going to make it an ETF and give me nothing. Lately, though, Costco's fallen from 307 to 286. Maybe that's not enough punishment. I don't know. I expect one more leg down before the stock's safe to buy. So maybe we get some downtime here, and then you get to buy Costco after it has come down. What a great pickup. Boy, owning Costco and PepsiCo, I think, are two antidotes to this market. You know what? Finally, on Friday, we get the Labor Department's non-farm payroll report for September. And as always, this is the most important piece of data we get from the government. Employment's been strong, but now everyone I know is acting like the good times stop rolling. I don't think that's the case. I expect another good number, which may make it difficult for the Fed to give us another rate cut. What would be best for the stock market? We need a labor report that's not too hot and not too cold. That way the Fed can cut, but no one will freak out because the data is terrible. Here's the bottom line. I know it's been rough, but last week this market was really overbought still. And when you're overbought, you tend to get hit with sell-offs. Exactly what I told you would happen is happening. That's why we raised a lot of cash for the trust, especially when we're being flooded with shoddy IPO merchandise, which, by the way, they should stick it with caveat emptor. And you can't, these aren't vacuum cleaners. I think we need some more downside before I'm really ready to get positive. But after waiting for the market to come down, some segments are getting very tempted, but not the money-losing, clothes-hanging Pelotons of the bunch. Dimitri in New York. Dimitri.
Yes, sir. How are you, Mr. Cramer?
Couldn't be better. Thank you for asking what's going on.
That's great. Well, I just got to tell you, first of all, I love your passion for the stock market. And more importantly, I love that you don't ignore the obvious. So my question is this. Align Technology. It's a great company. ALGN is a ticker. It's doing well.
Yeah.
It's profitable. What should I do here? Because the market reacted to a low guidance for Q3, and I'm not sure why.
Right. Just checking my new investment book since we're also fixated. I got to tell you, I think Align's dicey here. Smile Direct's doing so badly. I'd say you cut your losses. As Mal said, Align Technology is too high according to Marxism and Leninism. Okay. Sorry to break it to you, but I think we need some more downside before I'm ready to get positive. On Main Money tonight, as investors turn away from domestic biotech, is it time to consider pharmaceutical stocks that are from overseas? I'm giving it my take. Then, boom, chicka pop, boom, chicka pop, because, man, that bag is heavy. Slim Jims, I actually like the new kinds. And Hungry Man, my favorite snacks to healthy choices. Conagra Foods is behind some of America's biggest brands. Can it offer up a hot meal and a hot stock? I'm buying the company after earnings. And it's the company leading the fight against high prescription drug costs, and I use it. And it's coming after you, Mr. Prescription High Price. I'm talking to the CEO about its foray into telemedicine and ready clinics, or kind of, like hospitals and stuff. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.